Welcome to Market Movers. I'm Jim Urio. Last week we talked about the cheapness of risk, and guess what? Risk happens, and it happened very abruptly in the last 24 hours. Today we're going to be talking about the highly volatile crude market. Recently, OPEC has leaned into production cuts, and this weekend we have the Iranian election. Could end with a more radical government and a more isolation from the Western world. Joining me is Chief Investment Officer, Kingswood Asset Management, Scott Martin.
Hi, Jim.
Okay, so last week we traded gold and we traded ZN. Both of those trades worked out beautifully. Nice job, because you mentioned what?
Protection trade. I mean, this was about the ZN being somewhat of a protective area, I believed, and it was just the fact that protection was very cheap. And the fact if you wanted to take on some hedging or whatever you needed to do, you could do it because it was cheaper than it was to be not hedged.
Gold had been pummeled. Volatility in the ZN was very cheap. Volatility in the stock market was even
Sometimes
cheaper.
You got to take what the market gives you.
Okay, now on to oil. Which is more important? OPEC's recent talk with Russia about potentially extending production cuts or the Iranian election over the weekend?
I say neither. I think it's actually the fallout from today's rhetoric, which could be anything related to D.C. and worries about the economic agenda not taking place.
The reason I'm going to push back on that is because oil hasn't moved much today, despite the fact that the bottom is dropping out of stocks. So I'm going to go with, I think, we know about OPEC. We know what they want to do. The Iranian election is interesting. I'm not sure it's monumental yet, but if the more radical candidate wins, I do think that could add to the OPEC and Russia deal and push crude up even higher. Do you agree?
I agree, but remember, crude has been stuck in this range for quite some time now, so you get sellers at the top and buyers at the bottom, and it stays in that range, 45 to 55.
Agreed. Now, before we dive into our trade discussion, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to manage risk or create additional trade opportunities, not as trade recommendations or advice. Prices are going to vary and movements are going to vary. When we're talking about this now, the July, which is the underlying of both our trades, is trading at about 49.40. Scott.
So punched up some option trades for today, and talking about that range, Jim, let's just say tentatively it's 45 to 55. So you want to, I believe, operate within that range a bit. So I punched up a little bit of volatility measurements and thought, okay, where is some reasonable expectations? I looked at a straddle, in fact, and said, okay, what does the option market tell me as far as maybe where crude is going to move, say, in the next few weeks? So I punched up the 51.52 call spread. So it's about 28 ticks to put this on, or $280 to make a potential 720. It expires June 2nd. It has the underlying July on it because it is about the fill out of that expectation of volatility. If you look at the straddles of today to say where crude could move either up or down, I'm guessing that crude moves up.
I like it, and on the short term, I think crude will move up, and I think OPEC and Russia has something to do with that. I think in the longer term, the supply story is going to be the bigger story. And this, my trade, it's so similar. Every time we do this, you have a little bit wider, greater risk reward. Mine is less risk and a more narrow spread. We do this every time. So I'm looking at buying the week 1 June 51.5 call spread for 15 ticks. This trade risks $150 to make a potential 350. It expires that June 2nd. It also has July underneath, currently trading about 49.40. The thing I like about it is it's less money up front, so it's less risk, but of course it's less of a payout, but you get what you pay for.
Which tends to happen between the two of us, but it speaks to the importance of having that range on the charts or that price level where you're comfortable putting on some sort of exposure depending on what you're seeing at certain levels.
Okay, so what's the takeaway from the trade today? We've seen risk happens. Risk happens again. What are you taking away?
Risk is back, Jim, and volatility is back. And what speaks to me is, what is protection going to cost you these days? Because we've talked about so many times how you have to take what the market gives you. Protection, hedging now is going to be expensive after what we've seen in the market.
But there's ways to hedge where we buy and sell options and take advantage of that volatility cost as well. And we do that very, very well sometimes. Thank you for joining us on Market Movers. I'm Jim Urio, where we're helping to make you a better trader.